Hello traders, this video focuses on interest rates as a leading indicator for currency fluctuations or the movements experienced in currency prices. Kindly remember to like and subscribe. Interest rates are a fundamental driver of the foreign exchange market. Changes in interest rates and monetary policy decisions by central banks have a profound impact on the value of currencies. Join us as we present to you a detailed perspective on how interest rates affect the forex market in general. In this, we'll be looking at some aspects including interest rates differentials, carry trade strategy, inflation and interest rates, currency pairs and crosses, and risk-on fees, risk-off sentiment, amongst others. So the first element you'll be looking at is interest rate differentials. We see that one of the most direct ways interest rates influence currencies is through interest rate differentials. Typically, when a country's central bank raises interest rates, it usually attracts foreign capital seeking higher yields. As a result, there is increased demand for that country's currency, thereby giving it more strength or making it more stronger against other currencies. Conversely, when interest rates are cut, it can lead to currency depreciation since investors will seek better returns in other currencies. The next item is carry trade strategy. The concept of carry trade is closely tied to interest rates. Traders will often borrow money in low interest rate currency and invest it in a higher yielding currency. For instance, if the US Federal Reserve raises interest rates while the European Central Bank keeps the interest rates low, traders would borrow euros and invest in US dollars. This can lead to increased demand for the US dollars, making it more stronger while the euro becomes weak. In essence, what this means is that if you are looking at the chart, that at the given moment or period, the dollar would be rising, or rather, buyers would be buying the dollar while the euro continues or would continue to depreciate or fall, or rather, they would be shorting the euro. The next item is inflation and interest rates. Usually, inflation erodes the purchasing power of a currency. Central banks tend to raise interest rates to combat high inflation. As a result, a country with lower inflation and higher interest rates is likely to have a stronger currency. That is, if a country has low inflation while their interest rates are higher, then the currency of that country would be stronger, which means that buyers would more likely buy that currency versus the currencies it is competing against. The fourth or the next element you look at is the central bank monetary policy, and we see that central banks use interest rates to manage their economies. Typically, a hawkish central bank, which signals a willingness to raise interest rates, can strengthen a currency. On the other hand, a dovish central bank, which indicates a preference for lower interest rates, can weaken a currency. What you see in this is that the way in which banks tend to manage their economies is by either raising or being hawkish on the interest rates or being dovish on the interest rates. At the same time, the stance on such a bank has an impact on its currency. For example, a dovish central bank is likely to lead to a weaker currency. The next item that we look at is the impact on the yield curve. Changes in interest rates can affect the yield curve, which is a graphical representation of interest rates across different maturities. Shifts in yield curve can influence investor sentiment and trading strategies. We see that a shift in the yield curve can influence investors or the investor sentiment and the trading strategies that traders will apply on a given currency. So another impact of interest rates is on the safe haven status. We see that a country with high interest rate may attract investment as safe haven during times of global economic uncertainty. For example, or rather, the US dollar is often seen as a safe haven currency, and when interest rates rise in the US, it can enhance the attractiveness of the dollar. Or rather, as interest rates rise, more investors are likely to invest in the dollar in comparison to other currencies that it's traded against, such as euro, sterling, Japanese yen, and Swiss franc, amongst others. The other impact is the impact of interest rates on currency pairs and crosses. We see, or typically, interest rates don't just affect just a single currency. In essence, what we mean that is that they will not just affect probably the US dollar, but they also influence other currency pairs, or they influence currency pairs. For instance, if the US Federal Reserve raises interest rates while the Bank of Japan keeps the interest rates low, the USD Japanese yen pair may see significant movements. And so it is the case with other currencies. Then the other element that we look at is the global economic flows as affected by interest rates. Interest rate changes in one country can affect global capital flows, thereby impacting currencies beyond just the affected nation. This is particularly true for major currencies such as the United States dollar, which serves as a global reserve currency. So another impact by interest rates on currency fluctuation is on market expectations and forward guidance. Market expectations and forward guidance. You see that it is not just the actual rate changes, but also market expectations and forward guidance from central banks that matter. In essence, what we mean here is that traders will react by positioning their trends depending on how the central bank communicate their future plans for interest rates. For example, or for instance, if the Fed gives signs that it is likely to raise its interest rates during the next FOMC meeting, then there are traders that will begin expecting, or other traders will develop an expectation that the US dollar is likely to rise, and therefore they are likely to be placing buy position for the US dollar, or rather they can short other positions or they can take a short positions on other currencies such as the euro, for example, if the ECB had indicated that they are likely to be dovish on their interest rates. Finally, the other impact by interest rates is risk on versus risk of sentiments, and we see that interest rate differentials can influence market sentiment. In a risk-on environment, investors may seek higher yielding currencies, while in a risk-off environment, they may flock to safe haven currencies with higher interest rates. Typically, what we see is that interest rates have an influence on general market sentiment, or rather, the bias that traders will likely develop towards a certain currency. Let's see, in case of the US dollar, its value is significantly influenced by the policies and interest rate decisions of the US Federal Reserve, that is the Central Bank of the United States. When the Fed raises interest rates, the US dollar generally strengthens as it becomes more attractive to investors who seek higher yields. On the other hand, when the Fed cuts the interest rates, the dollar will generally become weaker. So we see, as traders, and even as we conclude on this bit, we see that it is essential to consider the other factors such as economic data, geopolitical events, and market sentiment also interact with interest rates to determine currency movement or currency fluctuations. As a result, or therefore, it is recommendable that traders and investors in forex market need to make critical analysis of a combination of these factors so that they can make well-informed trading decisions. Thank you for watching the video. Let us interact later on. Remember to subscribe.